Will the decisions that you make about real estate financing hurt you or help you in the next 5 to 10 years? That is what we are talking about today on this episode of the Never Lose a Deal podcast. I am your host, Lorillia Brown Phillips, and as always, this show is for real estate investors and business owners who are looking to grow their real estate portfolio, leveraging creative financing that is an alignment to their future goals. So let's get started. So, unless you are underneath a rock, as I film this podcast episode, it is now July 2026. And just to give you an idea of the landscape that is going on in the real estate market, there's a lot of uncertainty. And as well as a lot of uncertainty, foreclosures are up across the country. Foreclosures are up. And one may ask, okay, is this the time to contract? Do I sit this out or do I still invest in real estate? Now, I'm still going to continue saying what I've always said on other podcast episodes. The investors who are buying now, they are looking closely at their numbers and making sure it is in alignment to their current buy box, as well as lenders. A lot of lenders that I'm working with are being very conservative with how they are lending. And so these are some of the things that you want to take into consideration. Now, remember, I started off this episode by saying, is the financing that you choose, funding or financing, will it hurt you or will it help you in the next 5 to 10 years? Now, I just want to stay in that space for this episode because, like I said, as I film this podcast episode, you may be watching on YouTube or you may be listening on the podcast streaming sites. Depending on who you are listening to and what you are listening to. And if you heard me just a few minutes ago, anyone who is telling you that there are lenders who are going to allow borrowers to take all the upside where the lender is going to get no upside, it is going, those individuals are either trying to mislead you or they really just don't know. And I say this to say, right now, information is abundant. You can get information anywhere. I tell people all the time, people don't come to me for information because it's abundant. You can get it from Google, you can get it from all the different AI platforms. There's tons of people who are doing reels. You got AI twins, the whole nine. But there's very few people who can help you apply that information to the real world. And what do I mean by that? There is a subset of people who are sharing and telling people information that's either based on their own experience or what they did in Chat GPT or any other AI LLM, large language model. They are not in the position of originating loans. And why is that the distinct difference? Because anyone right now in 2026 can go online, binge some content, get some ideas from, like I said, any type of AI platform and say, hey, I can help you get 100% financing. Now, I did that. I've talked about that in other episodes. I'm not going to stay, very long on that topic. 100% financing does exist, but it has to be created. That is a creative financing strategy. But many people are being told that there are lenders who are going to give you 100% financing. And as I said a few minutes ago, there's no lender out there, and I don't claim to work with them all, that now in 2026 is going to let borrowers get all the upside. The industry is not even built and created like that, whether we're in a good market or bad market. There's no lender who is going to let you just get all the upside. And I say this to say, and that's why I'm doing this episode, because everything that I do is based on experience. I recently, and I'm going to tell you the story, I recently had a conversation with a person who came to me and they are looking to build out their portfolio. They're getting close to retirement. And if you listen to me, there are very key details. Close to retirement, they are currently in their 60s. They're looking to retire in a few years. They've built up a nice nest egg in terms of now everything is relative, but they've built up a nice nest egg that will fit their retirement goals. It's not for the internet to judge because everybody on the internet will have you thinking that everyone's a millionaire. But going back to what I was saying, this person built out a real estate, a retirement plan that works for them. Along with, they want to add real estate as part of their portfolio. So they own where they currently live, but they're new to investing and they want to get into investing. Well, lo and behold, as I mentioned to you, keywords, like I said, person is in their 60s, just have a few more years to retirement. They were advised to pull money out of their retirement account to be able to invest in this particular real estate multifamily that they want to buy. And I say this to say, um, no, of course, all these alerts would come up. I say this to say no consideration was taken into account of this person's financial needs. And one may say, well, that is not necessary if a person is trying to get a financing. All you have to do is figure out what type of financing that person is looking for. And you know what? And there is some truth to that. Yeah, depending on how people run their businesses, that may work. But it didn't work for this person, and this person realized that they needed something a little more um, personable for them because the person who was providing them with the advice of financing um, didn't take things into account. And and when I say didn't take things in account for that person. Because if they dug a little deeper, they would have knew that that person was close to retirement and them leveraging their retirement plan to invest in real estate was in actual not a good idea. And one may say, well, then that person should have shared with them whatever. I get that. But when you are in the business where you are providing advice to people or helping people make a financial decision that plays a very large part in how, with a person's financing or finances, um, a little more details should be asked. And that's why I'm doing this episode, because the financing advice that you can give or you can get from a person can hurt you in the next 5 to 10 years. See, what a lot of people don't realize is that you have individuals who um, have had success. And the success started in 2020. And if you go back in 2020, let's do a flashback in time. Real estate was up. And how do I know? Because I'm involved in it. Real estate was very lucrative for me. And as well as other people that I know who was in the industry. And that went all the way, I say, to about 2022, and things seemed to about taper down in 2023. Things shifted. So you have people out here that are giving advice who have never been through a real estate contraction. Never been through all they know is up, 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 up. And it may not be up for them now, but they're maneuvering some things. And my caution to those who don't have that much runway, be very careful. Because the 30 something year old, and yes, I'm going to put on my auntie hat, they got plenty of runway. They can make a lot of mistakes now in their 30s and they can be back up by the time they get 60. They can be back up. And now with things moving so fast, you probably only need about 5 to 7 years. They can be back up probably sooner with the right relationships. I say this to say if you're in your 60s, you may not have that much runway. If you're in your mid 50s, you may not have that much runway. So you want to be very careful because, yes, the financial decisions that you make today can hurt you in the next 5 to 10 years. And why is that? Because real estate is not a credit card. You make a boo-boo with a credit card, you got experts online who will tell you all the creative ways that you can walk away from the debt. And by all means, that may work, but it doesn't work like that in real estate. You get the wrong financing, you take the wrong advice, and all that information gets now recorded. You are on the line. Now, I know we got those credit gurus who going to say, well, you got the truth in lending and all this other stuff, and they got a loophole to a loophole with attention. That truth of lending hustle doesn't work in the investor space. That's a different type of financing. All those rules that protect consumers, they do not protect investors. So when you decide to want to give advice to help people be investors, but you think that they are going to get all the loopholes and all the covering that consumers get, is going to leave the person on the other end holding the bag. So that is why I want to say, and as I do this episode, is now is the time that you have to protect your neck. It's a lot of bad advice. And I'm going to go back to that individual after having a more deeper dive conversation with her. No, we don't have to touch your retirement funds to assist you with getting into that multifamily that you want to be able to buy. We found some creative ways to be able to do that. So this is what I'm sharing with people. There's a framework that I have put together myself. This is based on my years of experience. I don't binge watch other people's content and then try to keep it and say it's mine. So this is based on clients I've worked with, experience that I have, as well as what I'm currently doing now. Because going back to when you are actually originating loans, helping people get actual financing, where you're working with lenders to originate loans, you will notice that there is a total mismatch with those who are just giving advice. Because there's plenty of people who just give you advice. They'll just give you advice, and then they'll tell you to go run and find somebody who's going to help you fix this advice. And I tell people all the time, I'm a big advocate of return to sender. Someone gives you an advice, you go right back over there to them because they have a whole network. They say they have lenders, they have that. You need to be going to them. So I am a big advocate of return to sender. I'm going to push you right back over there to the people that you are listening to, because what I'm not going to do is try to untangle somebody's, mess of a mess. Because going back to, and I've said this in another episode, if a person who is originating loans, whatever they want to call themselves, mortgage broker, loan officer, what have you, they know that every situation is different. They know that. And they also know they can't promise you they are definitely going to give you a loan. So that's why I tell people you have to be very careful. You see other people do things and have gotten success, and they are doing deals, and they have did deals, and they are currently doing deals, and they can give you the cell phone number of their direct lender. It doesn't mean your financing is going to work that same way. Especially if you are new out to gate, if you're a new investor, because now lenders are being very, at least on the investor side. And I can't, like I said, I'm not speaking for all the lenders out there, but I bet you if you did a sample, there's a good amount of lenders who, if a person is new to the investing world, they are going to look very closely on mitigating their risk with that borrower. So don't think that, hey, my guru, my influencer, my coach, whatever you want to call them, is doing deals, is done deals. Uh, they're getting this, and you think you are going to get that same thing. The only way that is going to happen if they are going to sign their John Hancocks, and I doubt it. If they are online and they have built a great community, they ain't putting their John Hancocks on everybody who they work with to say, I'll back them. That's not going to be the case. So I say this to say, and I'm going to share this. I don't want this to be a very long podcast episode, but I will share with you a framework that I have put together that has helped my clients be able to mitigate the pitfalls of not doing things when it comes to funding and financing that can hurt them financially. And I have used this even. How is it going? Are you still trying to figure out how to build out your real estate portfolio? I know all the gurus online just told you, just put in a Google search, find an asset-based lender, and voila, you are going to find the lender of your dreams who's going to give you 100% financing, and you are off to the races being a real estate millionaire. But you know that isn't true. So this is what I want to share with you. There is a way that you can build out your real estate portfolio with no confusion, because you want more than just a Google search. You want more than just talking to somebody on the other side of the computer who's pretty much just giving you a rate sheet and maybe some terms. I get it. And you are frustrated. But let me share with you, there is an easier way. There's a way that you can build out your real estate portfolio and have that personalized touch that you have been searching for. You want more than just random Google searches and overused AI prompts that have been used all over the internet. You want to build your real estate portfolio with expert guidance, and you want to be able to be given lender recommendations that have been vetted and suited just for your situation. If that sounds like you, I want you to join me at my next workshop. In this workshop, I'm going to share with you my 3-step framework. In this framework, I'm going to share with you how I've been able to help clients, real estate investors, experienced ones, build their real estate portfolio with ease and eliminate all the confusion that they have been hearing online. So if that sounds like you, I want you to join me at my next workshop. You should see it here on this video, and I look forward to sharing that information with you. See you at the workshop. Just business funding. Um, and so I know that this works. I've used it when I was just doing personal credit. It's worked with business funding. It continues to work even with business funding coupled with asset-based lending. It still works because it's been tested, and I've did it, so like I said, this ain't something I just got off the internet. But the way it is it's different parts of the framework, but I'm going to give you three of the core things. And the first thing is clarity. You want to be very clear on what it is that you want to invest in, not what you see your and I tell people all the time, there are people who come to me and they want a trusted person to be able to work with them, because I have told people there is a good chance that um, there is better financing in your local area. Many of the lenders that I work with are nationwide, and they can finance in many states. But sometimes there are some benefits of you using a regional lender, meaning you can be in Indiana and you want to invest in Indiana, and you go to your local RIA and you've been talking to some of the regional lenders in Indiana who are boots on the ground, they have offices there, and the terms are better. By all means, go with that. I'm not going to never say go with the lender I have if your terms are better. But this is where people come to me for. They want me to be the sounding board and the eyes, as well as the brain behind, is this a sound financing for me to get? Because let's be clear, and this is for my professionals who are in the mortgage industry. You don't get paid to advise. Any mortgage professional will tell you you get paid on performance base. What does that mean? That means that you get paid by closing loans. There may be a few who run their own shop and they may can do a little more than those who are under them, but most of the time the industry is closing loans and it's a commission. It ain't based on advising. So you can't sit there and advise a person and you don't know if you're closing loans. But with me, since I have the freedom to be able to have two sides of my business, because I tell people, if you just want a quote, you want a term sheet, you got a deal, you can work the numbers, you go right to my website, funds.neverloseadeal.com. There, you can do everything. You can work out your numbers, especially if it's a DSCR loan. You can figure out the financing. You can learn what you can even submit information, and you will get a term sheet within 24 hours, sometimes even sooner. That's because everything is automated now. Everything is automated. We even have an app that I don't even talk about here on the Never Lose a Deal podcast for people who want to creatively put together different financing options and get a printout and then be like, oh man, I never thought about doing a deal like that. I have an app just separate that I don't even talk about here on this platform. People do use it, and um and it is being marketed. I just don't talk about it here. And so that's a way. So there are technology has created a lot of ways for people to be able to be very involved in that process, because with information being as abundant as it is, most people want to run their numbers themselves, especially going back to the Indiana example. If you have a regional lender and the terms are better, because many regional lenders are doing that, they are going to do better terms than probably a nationwide lender. Go with those terms all day long. Like I tell people, no, you go with that. Go with I can't beat those terms. Go with those terms. But they'll come to me, and that's on a separate side, and they'll come to me for advisement. I need a trusted source, Lorillia, and that would be me. And that trusted source is someone who, like I said, can be the eyes as well as the brain behind making sure that this is in alignment to what it is you want to do. So I know you're saying, Lorillia, what is this framework? So, like I said, it's a framework with many parts, but I will give you the three main ones that I focus on. Number one, clarity. You want to be very clear that what you are investing in is what you want to invest in. And is that is in alignment with what your future goals are. That's number one. Number two, definitely want to be able to look at how you want to grow the portfolio. How does it look for you? What does it look like? Not what it looks like for a person you see online or maybe a friend of yours or whatever. What does the growth of your portfolio looks like? Well, I really don't know what it looks like, Lorraine. Okay, then I'm gonna give you some ideas of what it could look like and see if it fits what it is that you want to do. So we got clarity, we got growth, and then the third thing is your financing identity. What is the best financing that is going to work for you? Is going to look at, are you taking on too much debt? Are you over leveraged? These are the same things that I did with business funding. That is why I've had people who looked at it and said, hey, I wanted to invest in this. And then when I looked at the funding that I needed, I realized that I didn't need that much funding. So that's why I always say the deal comes first. The financing is last. That's why with this framework, and I'm only giving you three steps, but the last one is always going to be your financing identity because the financing is last. The deal comes first. Um, People can get financing. I tell people all the time, financing is easy to get. What's not easy to get is the finding deals, especially in this market, because unfortunately, the internet has fooled people to think that if they can get financing, they have a deal. So people think that, oh, if I get a mortgage loan, I got a deal. No, it goes the other way around. That is why you will see investors who will get under market deals because they are buying deals that are under the market rate of a home. They're not buying market rate just because they can get financing. So, like I said, if you don't want your funding or financing to hurt you, in the next 5 to 10 years because unfortunately we live in a time and place now where that can happen. You can get hold of the wrong information from someone who's had a good 5 years. A lot of people are being honest and saying, hey, I just got started in 2020 and I'm up. You've never been through a contraction because the real estate has been good up until this point. So now, some people can still teeter totter or whatever, but what about those people who was around back in 2008? You know, I've shared those stories with you all the time. A lot of people haven't been through that. And that is why now I'm bringing guests on the Never Lose a Deal podcast so you can listen to more experienced people and get their perception of, hey, been doing this for a long time. I think in my last episode, I had a private lender who talked about real estate being in cycles. Many people don't even take that into account. So you have people now, we're in a contraction, and you got people still telling people, we up, we up. Doesn't mean you can't find deals. Like, don't get me wrong, deals happen in every market, but not in the volume of people telling you everything is up because that's not the market. I say all that to say, if you are somebody that wants to go a little more deeper in the framework that I talked about, like I said, I talked about just three parts: the clarity, the growth, and your financing identity. I want to share with you where you can learn more about it. If you go to www.neverloseadeal.com, there you will learn more about taking the next step. If you are saying to yourself, Lorillia, I need more than just someone who can get me a mortgage loan. I tell people all the time, looking for a mortgage loan isn't hard. You can Google, you can go on any social media platform. There's tons of people giving you information, can give you term sheets or what have you. But there's a very few people who are going to be the eyes as well as hold your hand during the whole process, be your trusted advisor. And those are for people who respect the trusted advisor relationship. Having a trusted advisor is not for everyone. You will have people who will tell you, oh, you know what, you just need a mortgage lender. It doesn't happen. It goes back to, like I said, the client of mine who's in her 60s, and anyone who is in the mortgage industry knows that every mortgage person does a sweep to see what assets you have. And that's what was done. A sweep was done, questions were asked, and that person saw, oh, they have a retirement account. Okay. And then when the question was asked, okay, where are you going to get the down payment for the multifamily? The person told them, I'm not quite sure yet. And that's when the red flag came up that it was recommended to use the retirement account, because the person, when they asked a little further about how much was in the retirement account, they went on a whole tirade about how the retirement account can be the vehicle to help them get into the multifamily. So, like I said, go to www.neverloseadeal.com if you want to learn more about how I am currently helping real estate investors, business owners, find the best solution that works for them to build out their real estate portfolio. And also, you want to make sure that the advice that you are given does not set you back for the next 5 to 10 years, because the wrong information doesn't, I don't mean to make this a doom and gloom episode, but if you have any care, if you're concerned about your personal finances, your business finances, and you know you don't have a lot of runway, if you 30, by all means, you can flip the bird, do what you want. You got more runway. But that person who is in their mid 50s or in their 60s or even older, they don't have that much runway. And so that is why you need to go to www.neverloseadeal.com. Until the next episode, I will see you then.